Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing from Molina Healthcare, and trust me, it's not as boring as healthcare paperwork usually is. We're looking at an agreement that gives them access to a lot of cash, so let's see what they're planning to do with it. Molina Healthcare just made a change to their existing credit agreement, a deal that basically lets them borrow money. They made what's called a third amendment, think of it as a revision or update to their credit agreement. This means they've tweaked the terms of how much they can borrow and under what conditions. The key here is that Molina now has access to more money. The new agreement, which they are calling the amended credit agreement, is similar to the previous one, except for a few key changes that allow them to borrow even more if needed. Let's see what those changes are. First, they've added something called a delayed draw commitment. Think of it as a line of credit, a pre-approved loan they can tap into later. This commitment gives them access to $500 million. Sections were added in the agreement to reflect that they can use these loans for general needs within the company and its subsidiaries. However, there's a catch. They have to be following the rules of their agreement as it pertains to their financial situation. This means they can only borrow if they are in good financial standing. The agreement also describes how much interest they will pay when they use this delayed draw commitment. The specific interest rate, or the applicable margin, is dependent on the type of loan they take. They also defined a period for the delayed draw commitment. Molina can access this money between now and June of 2025. This is called the availability period, and a delayed draw commitment termination date were added to reflect that. So basically, they have a few months to decide if they need the money. If they do borrow money through this delayed draw commitment, there's also a set repayment date. Any money borrowed has to be paid back by February 19, 2027. That date is called the delayed draw maturity date. Here's an important detail. Even if Molina doesn't use the $500 million, they will have to pay a small fee. It's like a ticking fee of 0.25% per year on any unused portion of the commitment during the availability period. This ticking fee is paid quarterly. It's like a holding cost for having the option to borrow that money. The financial obligation is there whether or not they use the credit. Molina's basically getting a financial tool they can use if they need it, and this amendment tells us the details of how that tool works. So, what's the big picture here? Molina is making sure it has access to cash. They are strengthening their financial position by giving themselves the option to borrow a significant amount of money if opportunities arise or if they run into unexpected expenses. Now let's step back and analyze what this might mean for Molina. Molina seems to be preparing for growth or potential challenges. Having access to $500 million gives them flexibility. They can use it to acquire other companies, invest in new technologies, or simply have a safety net if the healthcare market becomes turbulent. This move shows they are proactive in managing their finances. However, there are also risks. Taking on more debt, even if it's just a potential debt, can put a strain on their finances. If they borrow the money and then struggle to repay it, it could hurt their profitability. Also, paying a fee for unused credit isn't ideal. It's a cost they incur even if they don't get any immediate benefit from it. Looking at Molina's overall direction, this move suggests they are cautiously optimistic. They are preparing for opportunities but also aware of potential risks. The healthcare industry is constantly changing, so having financial flexibility is crucial. From an investor's perspective, Molina looks like a solid player in the managed healthcare space. They're not without risks, especially with the ever-changing government regulations in the healthcare sector. But they also show a pattern of making smart decisions, such as securing this line of credit. Based on their financial performance and market position, I'd say a reasonable price range for Molina's stock would be $375 to $425. The stock has been trading in that range for a bit. I'm slightly bullish on Molina, meaning I think there's a good chance the stock price will go up. However, investors should keep an eye on the healthcare policy changes and the company's debt levels. Thanks for watching Corporate Decoder. If you found this analysis helpful, please subscribe for more financial deep dives. Let me know in the comments what companies you'd like me to decode next.